Welcome to Mind Your Money. I'm Allie Canal, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, the free application for Federal Student Aid, or FAFSA, opens October 1st. We'll talk to an expert about what applicants need to know. And adjustable rate mortgages are staging a comeback as buyers seek lower rates, our housing reporter explains. Plus, all things pet insurance, we dive into everything you need to know to take care of your furry family members. The free application for Federal Student Aid, better known as FAFSA, is the annual application for financial aid provided by the government, including scholarships like Pell Grants and student loans. The Department of Education confirmed the FAFSA for the 2026 to 2027 school year will open by the federally mandated date of October 1st. Here was some advice for parents and students is Kathy Mueller, Mapping Your Future Executive Director. Kathy, thank you for being here. Let's start with why the FAFSA is such a crucial piece of the college financing puzzle, and how would you compare that to scholarships or private loans?
So the FAFSA is a very crucial part of the process of applying for and pursuing post-secondary education because the FAFSA is used for a lot of different types of financial aid, not just federal. Even though it has federal in the name, it's also used by states for determination of their state financial aid programs. And colleges and universities also use it for their institutional aid. And even some private foundations use the FAFSA information for private scholarships as well. So all students really should complete the FAFSA, whether they think they will qualify for any federal need-based aid and maybe they think they don't want student loans. But it's really important to go ahead and complete the FAFSA because it qualifies you for all kinds of financial aid. And also, it will help you determine whether or not you qualify for any need-based aid.
So we have that opening on October 1st. Why do you recommend families submit the FAFSA as early as possible?
So some really good news, the FAFSA is actually already now available. The Department of Education announced just yesterday that they've released the FAFSA ahead of the October 1 date. So that's great news. People can go ahead and fill it out right now. But there are several reasons why students want to go ahead and fill it out as early as possible. One of those is that when they complete the FAFSA at the very end, they're going to get an estimate of their federal financial aid eligibility. Now, that's just a federal part of it, but it will let them know if they qualify for any need-based aid, and it kind of gives them an idea of what college or school or university they might be able to afford based on that federal financial aid estimate. Also, it's an important part of the college planning process. So the sooner you get that task done, the sooner you can focus on other things like applying for admissions and applying for scholarships, writing essays, or taking entrance exams. So all of those are important parts of the college planning process. And finally, one of the main reasons you want to get that done is there is some financial aid, particularly institutional aid, and that's the aid offered by schools, colleges, or universities that is awarded on a first-come, first-served basis. And so you want to get your application in early, and if you're eligible for that, you'll likely receive it. Now, schools and colleges and universities have what they call priority deadlines, and as long as you meet that priority deadline, in most cases, you're qualified for institutional aid as long as you're eligible. But it's still important to go ahead and get it in as soon as possible.
And for people new to this process, how do you get started? What documents should you have on hand so that you're prepared when you open that application?
So the first thing that a student and at least one parent, if the student is considered dependent, needs to do is to set up their account at studentaid.gov. And to do that, really what they need is their social security number. They'll need other personal information, and they'll want to have their phone with them as well for multi-factor authentication setup. But it's a really easy process. It's probably similar to other processes in creating accounts. But I do encourage both the student and the parent to make sure that they get their Social Security number correct when they set up that account at studentaid.gov, because the Department of Education is going to verify the student and the parent or parent's information with the Social Security Administration. So you want to make sure you have that accurate, because that's going to be matched up, and you want to make sure it doesn't hold up any of your financial aid because there's a mismatch. Also, because they'll be doing that in real time, and you'll be able to go ahead and complete the FAFSA if you make sure that you have your Social Security number correct. And that's also something you can't really change easily. It really is a difficult thing to change if you get it wrong the first time. Also, the other thing that I recommend when you're creating your studentaid.gov account is don't use a work email and don't use a school email. This is going to be the account for the student and for the parent. They're going to each have their own account, and that's going to be their accounts for the rest of their lives. And so you want to make sure that you use a personal email address that you're going to have access to in the future if you ever need to reset your password. And if you use a school email, a student's going to graduate from school and they're not going to necessarily have access to that email in the future. And if a parent changes jobs, they won't have access to that email after they change their job. So I can't emphasize enough to use a personal email address you're going to have access to in the future.
And finally, Kat, I'm sorry to cut you off here, but no. I wanted to ask what some of the biggest changes students and parents should be aware of this year under the Trump administration, if there are any changes.
So there are some changes. One of the big changes that was a good change for a lot of people, and that is the change in asset information. In the past couple of years, if you had an asset like a business or some other investment or a farm, you had to include that whether or not it was a very big asset or not. Now they're saying that as long as you have 100 or fewer employees in that business or that farm, or now they've added fisheries, then you don't have to include that asset. Now, students this year will be under some new rules that were had gone into effect with the budget reconciliation bill that was passed this past summer. And the biggest change there is some of the student loan limitations. We don't know all of the details yet because they're actually going to be going through negotiations and setting out the rules for some of those. But we do know that parents are going to be limited in the amount they can borrow. Parents will only be able to borrow $20,000 per year per student for a total of $65,000 per student. Now, if a student is planning to attend a very expensive school or go out of state, that could have an impact on how much money they have available to them under the federal loan programs to pay for an education. They can look at other loan options, but it may be more expensive and harder to obtain. That's the biggest change really impacting students that are undergraduate students for the 26-27 academic year. There are some other changes too, and some of those are good changes, like expanding the Pell Grant program to include workforce programs. Again, the rules haven't been written for that yet, but we're looking for some expanded programs that students can take, like credentialing programs and certificate programs.
And Kathy, we're out of time, but there is so much to talk about on this subject, so we'll have to have you back. Appreciate your insights.
Thank you very much.
Well, American Express just introduced a major refresh of its popular Platinum credit card. Yahoo Finance personal finance reporter Ben Walker joins us now with the latest update. So Ben, what's new with this refreshed Amex Platinum card? And the question on everyone's mind, how much higher is that annual fee? What are we talking here?
Yeah, I mean, that's the biggest news with this refresh is that the annual fee went up to $895 from $695. So that's nearly $900 a year for this premium travel credit card. However, with the new price tag and with the refresh, cardholders can also get over $3,500 in potential annual value. And that's with loads of new and enhanced perks. For example, you can get up to $600 in annual hotel credit, up to $400 in annual Resi dining credit, and up to $300 in annual digital entertainment credit. With these three perks alone, you're already at $1,300 in annual value. And that's without counting any other benefits. So if the benefits make sense for you, the refreshed Amex Platinum, even with its $895 annual fee, is definitely worth considering.
So how do you compare the Amex Platinum to another premium travel card like the Chase Sapphire Reserve, which also just raised its annual fee?
Yeah, I mean, that's a great question. At first glance, both of these cards appear to be quite similar. The Amex Platinum has that $895 annual fee. The Sapphire Reserve is $795. And in that aspect alone, the Sapphire Reserve would appear like the better option. However, you really have to dig into the benefits of each card to see which one would be a better fit for you. For example, after its refresh, the Amex Platinum has quite a few easy-to-use benefits and offers more potential value than the Sapphire Reserve. But what if you have no need of some of these credits, like, for example, the Lululemon or the Oura Ring annual credit? If that's the case, it may make sense for you to look at the Sapphire Reserve's credits to see if they make sense for you. And between these two cards, there's really no one-size-fits-all option. The better card for you is the one that aligns with your lifestyle and spending habits.
And what about the Amex Platinum versus the Capital One Venture X?
Yeah, I think this is an easier comparison because the annual fees of the Amex Platinum and the Venture X are so different. If you want to pay $500 less and still have some great travel benefits, including airport lounge access, then the Venture X is the way to go. It's still a premium travel credit card, but you don't have to worry about so many different credits. It's a very straightforward card. It has a simple rewards rate, and you can easily offset the annual fee each year with just two benefits. You get a $300 Capital One travel credit and 10,000 anniversary miles. However, the primary reason to go with the Amex Platinum over the Venture X is if you're able to use many of its credits and benefits. If that's the case, you can definitely get a lot of value out of the Amex Platinum.
So if we compare all three of these cards, is there a clear winner? I know it's dependent on what perks you will ultimately use, but in your eyes, does one stand out among the rest?
Yeah, I mean, it's hard for me to say that there's a clear winner because it definitely does depend, on your lifestyle, your preferences. However, I will say that overall, the Amex Platinum has the most potential on the surface to provide you with a ton of value. But if you want a more cost-effective and straightforward option, the Capital One Venture X is an excellent choice.
All right, Ben, thank you so much for breaking all that down. Appreciate it.
Thank you so much.
Well, adjustable rate mortgages, which fell out of favor in the aftermath of the financial crisis, are catching on again. Here with the story is senior housing reporter Claire Boston. So Claire, to start here, what exactly is an adjustable rate mortgage?
Hi, Allie. So as the name suggests, an adjustable rate mortgage, the interest rate can change over time. Typically these days, you get either a 5, 7, or 10-year period where you have a fixed rate on your mortgage. And then after that period expires, if you're still holding that mortgage, the rate will start to adjust based on the prevailing market rate. So that means it could go higher, it could go lower. In exchange for taking on that extra interest rate risk, you can often get a lower rate than what is available with a 30-year fixed. Right now, 30-year fixed rates are 6.3, 6.4%. Adjustable rate mortgages will be around 5.8% for that 7 or 10-year period. So there's savings there if you're willing to kind of stomach that risk.
And you say that these types of mortgages are catching on. Where is that showing up in the data? How do you gauge the popularity?
Definitely. So the Mortgage Bankers Association keeps data on market share and how much these mortgages are being used. A couple weeks ago, we hit a post-crisis high of about 13% ARMs. This past week, it fell a little bit to about 9%. That being said, in some years, we've seen as little as 1% ARMs being used. They really fell out of favor after the crisis, but they're coming back now. And from what I hear, it's because people are really looking to get those lower rates, and ARMs are a way to do that.
And you said they're coming back into vogue again after what we saw with the boom and bust housing market, the 2008 financial crisis. How are today's ARMs different?
Definitely. People are pretty scared of ARMs because they just remember something happened with them in 2008. Basically, back then, ARMs could adjust as frequently as once a month when you were in that adjustment period. These days, the adjustment period typically lasts 6 months or a year, so you don't get those surprises. You know what your rate is going to be for a little bit of a longer term. It's also really hard to qualify for an ARM. You have to be a very highly qualified buyer. You're going to need a good credit score, a good down payment, and the income that shows that you will be able to pay your mortgage even if your interest rate does rise. And that really wasn't the case in 2008, but things have changed since then.
And how closely are these mortgages tied to the federal funds rate, especially since we know the Fed has started its easing process?
Yeah, we talk all the time on here about how when you have that 30-year fixed rate mortgage, it is not directly tied to what the Fed is doing. But ARMs are a little bit different because when you're in that adjustment period, you are tied to something called SOFR. And SOFR is very closely linked to the federal funds rate. And so if the Fed starts easing and you're in that adjustment period and SOFR falls, you may actually see your mortgage rate go down. It's a little early to tell, what is going to happen this time around, but the Fed did just cut. They say they may cut a few more times, and that means that as an ARM in an adjustment period adjusts, there could be a little bit of rate savings for those borrowers.
All right, we'll see what the Fed ultimately decides to do. Claire, thank you so much for joining us as always.
Thanks, Allie.
And for more mortgage content from Yahoo Finance, scan the QR code below. Lots more personal finance tips and tricks ahead, plus our weekly segment, Ask Yahoo Finance Anything. That's after the break on Mind Your Money. For many of us, pets are part of the family. And just like people, a trip to the doctor, or in this case, the vet, after an injury or illness can get pretty pricey. That's why more pet owners are turning to insurance to help cover those medical bills. When you buy a pet insurance policy, you'll typically choose between your annual limit, deductible, and reimbursement percentage, also called coinsurance. Most insurers only cover dogs and cats, but a few extend coverage to other animals. According to 2023 data from the North American Pet Health Insurance Association, the average annual premium for accident-only coverage was about $116 for cats and $204 for dogs. If you add illness coverage, the premiums rise significantly, and they go up even more if you tack on a wellness plan. Policies generally cover a wide range of conditions, but not pre-existing ones, meaning anything your pet already had before the policy began or that developed during the waiting period will not be included. Deductibles usually come in one of three forms. Annual deductibles, where you pay a set amount each policy year before coverage starts. Per incident deductibles, where you pay each time a new condition arises. And lifetime per condition deductibles, where you only pay once for each condition over your pet's life. As for claims, the process is generally simple. Most of the time, you'll pay the bill up front, then submit proof of payment and a detailed invoice for reimbursements. Some companies, though, will pay the vet directly. That's a helpful option if you can't cover the full cost at the time of care. So what exactly does pet insurance cover and what does it cost? Let's go over the details with Yahoo Finance insurance editor Tim Manny. So Tim, let's start big picture here. How long has pet insurance been around and why is there a growing need for it?
Well, you hit the nail on the head in the introduction. Pets are our family, and we want to care for them like we do members of our family. So, believe it or not, Nationwide Insurance introduced pet insurance in the U.S. in 1982. There was this famous press conference with Lassie the dog up there at the podium. And so what I really try to educate pet owners on regarding pet insurance is you don't want to be in a situation where you have to make a tough decision purely because of finances and not having coverage.
And when a pet owner wants to sign up, how does that process typically begin and who are the main providers?
It can be really self-directed. You can visit an insurer's website. You can call them on the telephone. You can utilize a site like Yahoo Finance to compare multiple pet insurers at once. There are insurers that specialize in pet insurance, and then there are those big name insurers out there that offer all types of insurance, home, auto, pet, etc.
And are we talking about monthly premiums similar to human health insurance? And if so, how expensive can that get?
Yeah, we're talking monthly premiums. And, it can be rather affordable depending on the type and extent of coverage that you choose. We did some more recent research this year. We went to actual pet insurer websites. We filled out some forms. We got some pricing data. And across 12 different pet insurers, we found that for accident and illness, up to a $5,000 limit, average monthly payment was $87. If you choose a plan that gives you unlimited annual coverage, that average payment jumps up to $132.
And what kinds of medical conditions do these policies typically cover? And what are some of the common restrictions or exclusions in certain policy plans?
Let's talk about an accident and illness plan. That's pretty common. That's going to give you base coverage, but also a wide range of coverage. So we're talking about accidents, injuries, illnesses. Your dog, God forbid, swallows something. You need to get that diagnosed and checked. Chronic illnesses, even serious illnesses such as cancer and diabetes. There is an option to also add what's called a wellness plan to your coverage. That's not pet insurance per se, but like I said, it's an add-on. And that's going to give you coverage for preventative care, visits to the vet, vaccines, things like that.
So bottom line, is pet insurance worth it for most owners?
I like to say, again, and I'll reiterate the point I made in the beginning, you don't want to be in a situation where you have to make an unfortunate decision. You don't want to feel like your hands are tied and you don't have options with your pet, with your member of the family, simply because you don't have the financial backing. So is pet insurance worth it? I think it is to protect your pet in the most possible way.
All right, Tim, thank you so much. Appreciate those insights. And for more insurance content on Yahoo Finance, scan the QR code below. Well, it's now time for Ask Yahoo Finance Anything, where we answer your personal finance questions. This week, I'm joined by Bob Powell, host of the Decoding Retirement podcast. Bob, let's get right into it. Our first question here, one Yahoo Finance reader asks, I read recently that some companies are suspending 401k matches. How can I prepare if my company does the same?
Yeah, so Allie, it's not widespread yet, but you do want to prepare. So let's say you're contributing 6% of your pay to your 401k and your company's contributing, say, 3%. That brings your annual total to 9%. So if your company suspends that match, you could increase your own contribution to 9%. But if that feels like too much, you could do it gradually. Maybe when you get a raise, put that into your 401k, or maybe sign up for auto escalation, where you could increase the amount that you contribute by, say, 1 percentage point per year. Now, if you're older and you can't raise your savings rate, you may need to adjust your retirement plan. Maybe you need to delay retirement by 2 years, or maybe you need to think about what your expenses will be in retirement and trim them, or maybe you need to do both of those things.
And we have a question from another reader. I heard the IRS just finalized rules on Roth catch-up contributions. What does this mean for me? So yet another retirement question here for you, Bob.
Yeah, I know. It's my bread and butter, isn't it? It's sort of eat, breathe, and sleep, all things retirement. So if you're 50 or older, the IRS allows you to make up what are called catch-up contributions. So for 2025, the regular contribution limit is $23,000. But if you're 50 and older, you can contribute an additional $7,500, which brings the total to $30,500. Now, beginning this year, there's a new law that created what's called a special new catch-up contribution for people who are ages 60 to 63. And during those years, you're able to contribute the higher of $10,000 or 150% of the standard catch-up contribution amount. So once you turn 65, though, those limits reverts back to the regular contribution, the regular catch-up contribution. And I should note that not all employers are just not required to offer this special feature. There's a second change I should mention, Allie, which is this applies to higher earnings. And this is what the IRS notice was about. So starting next year, anyone with wages of $145,000 or more from their employer must make all catch-up contributions to a Roth 401k. And if your plan doesn't offer the Roth option, you won't be able to make up the catch-up contribution.
All right, Bob, some great answers there. Appreciate it as always. Well, that's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter and stay tuned for Market Domination. That's coming up next.